Okay, I think we should get started. If everybody's ready, get rid of this. So thank you everybody for coming. We're happy you're here. I'm sure we're gonna have some more people come in as we go along, so we'll keep our eye out on that. Thank you. My name is Jody DeSmit. I am with Reverse Mortgage Funding, and I am the president of PEPC this year. And again, I'm happy everybody's here, and we're always happy to have as many people as we can show up. We don't have a whole lot going on. If you can believe it, it is already November, which is crazy, almost to the end of the year. We did want to bring up, we do have a sponsorship available in December. So if anybody is interested in signing up for a sponsorship, please reach out to me or one of our committee members. Nicole can help direct you to the right person, or I can help direct you. And we'll have the sponsor filled by the end of the week. All the rest, just so you know, sponsorships are filled for the year. So this is the only slot available. So if anybody's interested in filling that spot, better jump on because it's going to fill up quick. But reach out to us. We'd be happy to have you. Next thing, we want to have Alana. Alana is going to give us a little update on our marketing, which is so important, we think, that to bring that up. So Alana.
Thanks. Jim, do we have our slide? Where? So, hi, I'm Alana Shapiro-Yadav, and I'm on the marketing committee. And as you may have noticed, we're really working on expanding our web presence. And so here are the links to follow us on Facebook and LinkedIn. It's a great way to really learn about all of our events that are coming up. Sometimes emails can get lost. It's also a great way to network and see who else is within PEPC, and a great way to connect with others. So if there's someone that you had talked to during a meeting or had a comment that you were interested in, you can find them there and connect with them and really take advantage of being a part of PEPC. So I will post the links, the live links in the chat so that you can just press on them, or they're all right here as well. So we hope to see you on social media as well. Thanks.
Thanks, Alana. And again, like, share, post. The more we get out, the better and stronger that our PEPC will be. So next, we have our sponsors. We have our wonderful sponsors. So we have First Republic Trust. We have Anna Previa and Cynthia Lemus, and they're going to go ahead and do their sponsorship. Go ahead, ladies.
Hi, everyone. Unfortunately, can't see all your faces, but I see a lot of familiar names, so good to kind of see you virtually. I am part of the First Republic Trust Company team, and happy to be sponsoring this event tonight. And I'll share a little bit about the company. So we have a slide's going to come up pretty soon, hopefully. So we have office locations, as you see, throughout the Bay Area, and Anna and I work out of the Palo Alto office. We are also, so we're chartered in California, we're chartered in Oregon, Washington, New York, and Connecticut, and Florida, and Wyoming, and Delaware. So we have quite a few states there that we're chartered in. Our trust officers have an average of 22 years of experience, so all very well experienced in the area of trust administration, and handle all types of different trusts and provide a variety of different types of services related to trusts. And Anna will get into that a little bit after I finish this. And you'll see that we have right now, as of September 30th, so fairly current, 12.3 billion under assets under custody and administration within the trust company. So we've been doing great. We've been quite busy during this pandemic, so hasn't really slowed us down a bit. It's actually, I think, made a lot of people think about their estate planning needs and trust needs. So I will turn it over to Anna to add some more information.
Great. Thank you, Cynthia. Good evening, everyone, and welcome to Peninsula State Planning Council. Cynthia and I are thrilled to be here as past presidents, so it's a fun opportunity for us. I'm Anna Paiva. I'm also a trust officer with First Republic Trust Company. The trust department essentially falls under the umbrella of private wealth management at First Republic. And under that platform or that umbrella, in addition to trust services, there are financial planning services, investment management services, and insurance services. There's a full offering catering to clients' needs on the private wealth management side. So many of you professionals out there, in addition to our full service trust offerings and acting in trustee and co-trustees of all different types of trusts, we also act as agent for trustee and agent for executors or administrators of estates. So I know that we have a lot of attorneys, estate planning attorneys out in the audience, along with professional advisors. And oftentimes you get your arm twisted to agree to act as successor trustee for your clients because you are their loyal advisor and they trust you more than anyone else. And so I can tell you that we act as agent for trustee for a number of attorneys and a number of professionals who, when the time comes that there's a need for them to step in and serve, they either don't have the time to do it or they've retired and, moved out of the area. And so, we've got that bandwidth where we've got the resources, the skill set, the procedures, the protocols. This is what we do day in and day out. We're used to dealing with complex families and complex assets as well. Just to give you a couple of differentiators for First Republic Trust Company is that a lot of our clients have built their wealth in closely held businesses, private equity. They have limited partnerships, LLCs. So we have a real estate and unique assets team that deals with those types of unique assets. We've got that specialty and that skill set. We also, this is the first institution or the first trust company that I've worked at that does not charge extra to act as co-trustee. We actually like working as co-trustee with family members or friends of family who bring the dynamic of the diverse family. They've got the knowledge and background, and so they can add value. And so that's very much a collaborative and team approach. So First Republic, when we act as trustee or agent for trustee, essentially we continue to work with all of you. We with the client's team. We don't bring in new players unless we need to. But we just become a component of that team. One more differentiator that I wanted to add is that we will work with outside registered investment advisors. If clients have a long-standing relationship with an outside registered investment advisor and they wish to have them continue to manage their assets, their portfolio, we will work with outside registered investment advisors. If they don't, we have First Republic Investment Management, which is a subsidiary of First Republic Bank, and there are over 140 registered investment advisors under that umbrella. So thank you for having us this evening. Jim is going to share a slide. Thank you, and enjoy the evening. We've got a great speaker and a great topic, and happy holidays as we start to approach that time of year.
Thank you, Anna and Cynthia. And again, we appreciate your sponsorship and with PEPC, and thank you for your past presence too. So next thing we have is our speaker, and we have Nicole that's going to introduce our speaker. Nicole, you're on.
Absolutely. So if Nick will hang on for just a second, I'm going to do a few bits of housekeeping beforehand. And then I have the pleasure of introducing our speaker. We're going to be working with two icons this evening on your screen for those of you who may be Zoom novices, which I don't think is many of us these days, but Keep an eye on the chat icon at the bottom of your screen. You'll see that there's some links in there, for instance, from our marketing committee on how you can stay connected with Pepsi. There was also a link kindly provided by one of our members to the free upcoming conference put on by the National Association of Estate Planning Councils. Again, it is free, and so it's a fabulous opportunity to connect on a wider scale with folks just like the folks that you're meeting at Pepsi. The other button that we're going to be working with is the Q&A button. And so the Q&A is going to be used for you all to post all of your fabulous questions throughout the presentation. We want this to be dynamic and fun for Nick. And so as we go along, if you have a question about what he's talking about or a thought that you want to share, feel free to put that in the Q&A. I'm going to be interacting with Nick and sharing those questions. And he's going to be addressing those questions as we go along. So not at the end of the presentation, but throughout. So do not wait with those questions, get them in, and we will have a fabulous time. One thing I forgot is if you have any IT difficulties or anything like that, if you go back to the chat and you tag our executive director, he can walk you through any technical difficulties you might be experiencing. So again, chat is for fun links, getting to know each other, any technical issues you may be having, and Q&A is where we're going to post all of those fabulous tax questions for Nick. All right, so without further ado, I have the pleasure of introducing Nick Shertock, who is with Shea Labaugh Doberstein. He is a tax director and a CPA with nearly 20 years of experience in public accounting in the Bay Area. He has worked as a tax advisor primarily for high net worth families, small business owners, and trusts and estates. He has extensive experience working with real estate sales professionals and their clients, as well as technology executives with complex equity compensation issues. Nick aims to be a trusted advisor and understand his client's entire financial picture. He enjoys simplifying complex tax topics while working with his clients' other advisors to form a team that will structure their financial affairs to create the very best tax outcome. Again, Nick Shertock, welcome. Take it away.
Thanks, Nicole, for that intro. And this is actually my first Zoom presentation. I've been using Zoom a lot for meetings ever since the lockdown. I've got 3 kids at home with me, and they're all going to school on Zoom. So I've gotten pretty good from that standpoint. This is my first presentation, so bear with me. Can you see page 1 here of my slide?
Looks great.
Okay, so when Nicole first mentioned this to me several months ago, lots happened since then in terms of we were just off of some new tax legislation with the CARES Act. There was the PPP program with a lot of clients getting loans, figuring out loan forgiveness. And we also knew there was an election coming up, and there was some early talk about, in fact, we didn't know who the candidates were going to be at that time, or who the Democratic candidate was going to be. So there were some different competing visions. And then since then we've had, we don't know who's going to be the president, but it does appear that the Democrats are not going to have control over the Senate. So it does appear that it's going to be difficult if we have a President Biden for major changes. So I do have a couple slides that address some of the Biden tax plan proposals, but as of now, the only one that I'm thinking is likely to go through is, and I wouldn't even say likely, I think there's some bipartisan support for getting rid of the state and local tax limit, the $10,000 limit. So I'm just going to get started. A little bit about our firm, Shea Labaugh Doberstein. We've got 3 offices. We do have the the San Mateo office, and I actually spent the last 3 years working in Palo Alto at another firm. I started at Shea LaBeouf about 1.5 years ago, and I live in Danville. I've got wife and 3 daughters here, and really wanted to stop driving to Palo Alto 3 days a week. And so they had opened a Walnut Creek office, and we have our main office in downtown San Francisco at 44 Montgomery. But we've got a pretty good sized presence in Silicon Valley with our San Mateo office. So if I'm meeting any of you down on the peninsula, that would be a good spot to meet. So talking about tax planning in general, why plan? What are the benefits of it? And you know, I have a list of clients that I work with every year, and it's not as though every single tax client actually goes through planning. So I wanted to kind of give a little overview of how a tax accountant handles the November and December year end. How do we look at what the, is it economical to run a full multi-scenario tax projection for every client? No, it's not really something that everyone does. And there's been a lot of change with the Tax Cuts and Jobs Act starting in 2018. It really had a big impact on the way we approach planning. So some of the benefits, you know, starting from, to me, the least valuable benefit, but something that a lot of clients want, is just knowing how much tax am I going to owe in April. And when we're talking about big dollar amounts, that alone can be enough to warrant actually running a projection, because a lot of clients, they don't like surprises. Planning out their cash, just being in a position so that me as the accountant, I don't want to be giving a client news that they were not expecting a few weeks before they've got to write a big check. So that can be a big part of it. You're at year end, and for clients that pay quarterly estimates, which is a lot of our client base, that's one aspect of why we do some planning at year end. We're also, for a lot of clients, we're really projecting every quarter to see where they are, especially the business owners, where the income really fluctuates. So when it comes to a business client, you know, the situation is a lot different than just a high net worth individual who may have a little more predictable stream as far as their wage income and their interest and dividends. And a business owner, you're looking at navigating the QBI deduction, which came out in 2018. So it's a qualified business income deduction, and looking at ways that they can really manage the profit, because they're more in a position to be able to control what their net income is going to be. Moving into kind of more strategy, you know, the real benefit of a projection is, and tax planning is not just to try to reduce tax in this current year. You're trying to do it in the context of multi-year, you know, if I project a decision that I make right now, how is that going to impact the tax in this current year? And usually I'm looking at 2 years out if it's something that has that impact. Sometimes it's just this year and next year. And so we're running a scenario or a couple scenarios and judging which is going to result in the least overall tax over multiple years, not just how do we just reduce our current tax and just have it be a timing issue. And another big benefit, perhaps the biggest benefit of planning, is the strategic decisions. A lot of times it's timing and a little bit of rate arbitrage, just because when the tax rates are graduated. And so if you're looking at someone whose income really fluctuates, you're generally going to do better to smooth the income in order to take advantage of getting income out of higher brackets, boosting it in years where brackets are lower. But in a lot of cases, you're really trying to avoid just missed deductions. A lot of it revolves around charitable donations. And then one of the bigger tax traps that I try to help clients avoid is having net capital gains in one year and then followed by big losses in the year after, just because capital losses are limited and they get carried forward. And so that's my last category here of why a tax projection or some planning can be beneficial, is really just avoiding missing the ability to take a deduction. And a lot of that also revolves around something called the Peace Amendment, which is currently not in play on federal returns, but it is on California returns, and it's an itemized deduction overall limitation. And so, I've done work on clients where they, and this was pre-2018, where the expectation was a certain benefit for making a large charitable donation. Once the actual tax return was done, and this was often done without planning, it was just something that the advisors told us about after it was already done, they saw that a lot of the deduction was actually lost because of itemized deduction limits. So looking at Q4 estimates, and here I'm going to move my screen over a little bit here. Okay, so we do want to make sure that clients aren't behind on estimates. That's another big reason to do year-end work. You want to handle, depending on their outlook on estimated tax penalties. I'm not going to go into how the penalties are computed, but essentially you've got some clients who don't want to pay any penalties no matter what. And so for them, it's worth it to take the time and make sure that they're paying their estimates on time. Then you have other clients who they just want to defer paying the tax as late as possible. They'll even owe tax in April and wait and pay it in October when they file the return. They just really would prefer to deploy their capital in their business. A lot of real estate people are like that. And so it's important to kind of know the client first before you just go head first. A lot of our staff will go deep into spending a lot of time on trying to nail down fourth quarter estimates when it's not economical in many cases. So I try to take a philosophy of really making sure that I'm adding value before I just spend a lot of time on estimates. So as far as putting things in context, and first I'll ask Nicole, do we have any questions yet?
Sorry, I've been checking the Q&A. So we don't have any questions right now.
Okay.
Feel free to continue on. I will try to pop up as questions come up, but thanks for checking in.
Sure. So prior to 2018, and I've been a tax accountant about 20 years. And so I spent many years as a staff doing December projections for clients. And the goal was often to make sure that if they owed state taxes, that you're figuring out what they owe, and then you would look at how much can they pay of the state tax before they go into AMT. So this is all before TCJA really changed things, and I'll cover that in the next couple slides. So a lot of what I'm talking to clients about right now is based on their experiences. A lot of them have spent 20, 30 years having anxiety around Christmas time of, okay, I know that we generally write a big check to the franchise tax board for our state taxes. And, a lot of them, they're familiar with these new limits, but they're just not sure whether they still need to be stressing out over this. So in a way, the amount of tax projections that we've done has drastically dropped off as a result of this new limit on state taxes, because it really doesn't change anything as far as when the state tax is paid. But historically, if we had a simple client and that their only issues were, are they underpaid on the state? And if so, how much can they pay before they go into AMT? And then you would often recommend prepaying property tax if you're just trying to accelerate deductions in the current year. And then, if they're going to make donations, making them by the end of the year. And that was just a common scenario for so many clients, which nowadays that's really changed. And I'll kind of go into some of the changes. Okay, but first I've got a little more detail on business clients. And when it comes to year end, part of the 2018 tax law change was this new deduction, the QBI deduction. So I know there's some CPAs in the audience. There are financial advisors, trust officers, attorneys. So I'm not going to go too deep into the deduction, except just to explain that it's a new deduction that started in 2018 for pass-through business income, which includes sole proprietorship income. So it was really a reaction to the lowering of the tax rate on C corporations to 21%. So that desire to reduce the C Corp tax rate is really what kicked off a lot of the tax reform that happened in December 2017. And when that started happening, there was an outcry for, what about the small business, the closely held business owners? They need something too. The big multinationals are getting this break, and there was some reform on the international tax side as well. And so this QBI deduction was designed to try to bring down the tax rate for business owners. And it was confusing at first because it was called the pass-through deduction. So a lot of clients thought, well, I need to set up some type of entity to qualify for this, which they really don't. So a sole proprietor can get this deduction also. It's a 20% deduction. The main issue with the QBI deduction are the phase outs. So there are a myriad ways that you can not get the deduction based on your income and based on the type of business that you have. If you are, it's classified as an SSB, a specified, it's really SSTB, specified service trade or business. So someone like me, an accountant or an attorney, I'm sure many of you have on your own tax return seen that you're not really able to get this deduction based on the profession that you're in. One of the reasons I've done a lot with real estate professionals over the last year and a half, getting a lot of them onto the S Corp structure, because real estate is not considered an SSTB. And so the ability for them to take this QBI deduction is more opened up, even if their income's very high, as long as they pay wages. So getting into that second bullet point, if you're, and I know that under the Biden plan, he was basically threatening that the QBI deduction would just be taken away if your income was over a certain threshold. I think it was 400,000. Doesn't look like that's going to be a concern. So I would say if you have clients who are in a business that is not something that's a knowledge worker type of business, like consulting, law, finance, also healthcare, I believe is classified in that same group. If it's a tech company or someone who's in real estate sales in particular, is an area that I've really focused on. They're able to pay themselves a wage and use that wage to essentially support taking a QBI deduction, even if they would otherwise be phased out. So that's a lot of year-end work is being done now in talking to business owners about if they have converted to the S Corp structure, because this does not work if you're self-employed, because you can't pay yourself a wage if you're self-employed, or if you're single member LLC, or if you're a partner in a partnership, you can't pay yourself a wage in any of those scenarios. So it really had to be the S Corp structure to get this pass-through benefit. And so figuring out what the appropriate wage would be in the S Corp is a big year-end planning exercise that we do, a lot of business owners. And there's kind of this magic percentage based on the way that the deduction is computed and how the limitations work. But it's essentially if you figure out what someone's profit is before the wage they pay themselves in an S Corp, and if they pay a wage of around, it's 28.5%. And it's just the way the math works out as far as being able to get a deduction of up to 50% of the wages that you pay. But as you pay more wages, your QBI, your qualified business income, actually goes down, and therefore the deduction that you can take goes down. So there's kind of a magic spot, and we look for that. I know under the Biden proposed plan, there was going to be this donut hole, as he called it, where currently the way that Social Security and Medicare tax are treated, if you're earning a wage or if you have self-employment income. Now, this doesn't apply to S Corp profit, but this is just for wages and income from a sole proprietorship or any other self-employment income from a pass-through. Currently, you pay the employer and employee Medicare on all the income, but there's a cap on the Social Security piece, which is 6.2% for the employer and employee, so combined 12.4. So Biden, when he was proposing this donut hole approach, which I really don't see happening now with a Republican majority Senate, had that gone through, there was going to be a lot more benefit to having an S corporation, because profits from an S corp, there's always been kind of this game played with S corp wages, where owners of S corporations would aim to pay a lower wage, and the benefit being there wouldn't be payroll taxes on their S corp profit. It didn't really do too much good once you got over the cap on the Social Security, because you're only saving the 2.9% of Medicare. And in California, if you have an S corporation, your tax, there's a 1.5% tax on your S corp profit. So that really eats into that savings. Nevertheless, a lot of celebrities have done it. I think Joe Biden himself has an S corp for his book income, and it was something that was being passed around the media a couple months ago. So, and I know there were big cases with Newt Gingrich years ago and other politicians who would use and they called it the S corp loophole. Now, if there was ever to be an approach where you started having to pay Social Security taxes again at a certain level, there would be a lot more interest in S corporations. And knowing the way that the IRS audits, I always tell clients it's better to have your S corp before there's some major change in the law that makes S corps more attractive, because it's just a better look if you're audited, and in the audit, reasonable comp, reasonable salary is always a big issue, and making sure that because if you set the salary too low, then they'll just deem the entire amount of profit to be essentially subject to payroll taxes. So I don't want to go too deep into S corps, but for business owners, that is a big area of year-end planning. Yes.
Sorry, just because we do have a couple of questions.
Good. Good.
I think that you may be leading into some of these, so I may hang on to them in the chat, but I just wanted to broach them with you.
Okay.
We had a couple questions about the CARES Act and RMDs.
That's coming. That's coming very soon.
I figured. And then the bipartisan bill to push the Secure Act minimum age. And then finally, about whether or not you might be recommending front-loading capital gains in 2020. I'm taking note of all of these questions. I can hang on to them in my pocket if that is where you're headed, but I thought I'd let you know that is what's front of mind with folks this evening.
Okay, I'm gonna first say I'm gonna talk about some of the CARES Act changes here in a few slides that's coming up. I am talking about RMDs and how it ties into a lot of Roth IRA conversion work that I'm doing with clients. On the secures, that I'm not that familiar. I know that there was a change in IRA distribution rules. I haven't really looked in depth on that. So maybe if the person with the question, if it's a very specific question, I may be able to answer that, or if not, I can get back to them. And then the third question that you mentioned was front loading of capital gains. And that was hinging on whether we had a Biden presidency and a Democrat majority in both the House and the Senate. Had that happened, which it does not appear that's happening, I mean, on the Senate side, it does look, I don't think they've called all the races, but it doesn't look like that could be pushed through. And that really would make it unlikely that I would tell a client to front load capital gains without any real indication that the Republicans would back a change to the way long-term capital gains are treated. Had it gone another way, then yeah, I would definitely, and there's been conversation with clients just lining up, you know, if they have a lot of unrealized gains that they are going to realize, the fact that they could lose that preferential rate and the fact that they could lose the step up in basis. I mean, that was going to be huge. As I've got a lot of estate and trust attorneys listening to this, and I'm sure they would agree that that would really throw a lot of planning into doubt. It just, the specter of this out there, which I'm viewing it as something very unlikely to come about. And so I'm not really telling clients to expect to lose the step up or to purposely pay tax on gains now out of fear of, 2021, 2022. Some other, people that are more in tune to the legislative scene, they may have different opinions on that. If someone has just huge amounts of unrealized gains and they're younger, and so they know that they are going to have to be taxed on it at some point. I do actually have some slides about, for people who are lower on the income side, about making use of the 0% long-term cap gain rate. So that is coming. So yeah, some clients actually, I do want them to trigger gains, but if it's high income taxpayers who are fearing a radical change in the way capital gains are taxed, I'm not recommending that at this time.
Okay, thank you. Well, I think we'll hang on to the CARES Act question, and maybe I'll bring that up when you get to that slide.
Okay, so one mention on the CARES Act and this was a pretty big one for business owners who the net operating loss carryback had been suspended. After the pandemic, there was this effort to find ways to help business owners that are struggling to get cash in their pockets. And so one of them was to allow carrybacks of losses starting in even prior years. So you can actually carry back losses to years where the tax rate was higher than it is now. So for a C corporation, going back to a 35% rate. So that's something for business owners to seriously look at, whether they can even create losses in 2020 if they don't have them in these other years. But a lot of them, they may not have even filed their 2019 returns, because in San Mateo County, there's an extension of the deadline because of the wildfires. So we still see quite a few clients who actually haven't filed for 2019 yet, but are looking at what their NOL can get them in a carryback. And so, but for 2020 planning, there's definitely an opportunity there to get back tax that was already paid in 2015, and then it rolls forward from there. So I'm gonna kind of skip through the theoretical review here, because I kind of went over it already. That cap loss limitation trap is something that I see quite often. So being very careful toward year end, if I see a client, they have realized cap gains, and a lot of clients, the stock market did tank in March. And so a lot of them, they felt that they were down in their portfolio, and they were year to date, but many of them actually triggered a bunch of gains when they did a little bit of desperate selling. And so I do see quite a few clients that have these realized gains, and then they're planning on triggering losses, and to wait until the year after you have realized gains to post losses can really be detrimental, because you've got to carry them forward, and capital loss carry forwards are one asset. I view it as an asset, and you lose it when you die. And so when I see an older client that has a $10 million cap loss carry forward, I always think, okay, that probably could have been avoided with some better planning. Okay, so real quick on when people who are employees, a lot of times on the HSA, they haven't actually made the full contribution. They're able to do that separately. If they're over 55, they can actually do, if they're married, they can do 9,100. And a lot of times we'll have to set up a second HSA account for their spouse to do that extra 1,000. And then FSAs, I see FSA balances get wasted fairly often. People are just not really paying attention to them, not understanding the grace periods and the run out periods. So this is all in the slides that can be reviewed later, but I want to keep things moving. Okay, the TCJA, the big changes were the standard deduction went way up, and the ability to take itemized deductions went way down, and AMT drastically was restructured. So the biggest change, not being able to deduct more than 10 grand of state taxes, I mentioned before, that really has altered the year-end planning scenarios. It was probably our biggest tool taken away from us as far as tax planning. And so you're all probably familiar with your own returns, seeing that limitation in play. And then we have the lower mortgage interest deduction. One thing that I do notice a lot of times is that when I get new clients and I look at their returns done previously, a lot of times the tax accountant didn't know that California didn't conform to the changes. So there's still a $1.1 million limit as far as your acquisition debt that you're allowed to take a mortgage interest deduction on. So for a new property, you've got one limit for the federal side of 750,000, and a limit for California that's almost 50% bigger than that. And so I see that error on most of the new returns that I get. I see that they didn't make any adjustment for that. The charitable contributions have been made a little bit easier with this 60% of AGI limit. So there's been a lot of planning around philanthropy this year with clients who have just traditionally made big contributions and have been up against that limit because they have so much muni bond income. They've never had that much AGI to absorb all these donations. So that's helped make cash donations a little bit more favorable, although I usually try to encourage donation of appreciated securities whenever it's feasible. And I have another slide on that I'll go into. One of the big changes from TCJA was the elimination of miscellaneous itemized deduction. So for a lot of you, that would include investment advisor fees, the estate planning fees. We used to see that as a fairly common deduction subject to the 2% floor. That is not allowed on the Fed side, but California didn't conform to that either. So I'll often see that as something just kind of missed on returns. So, from a planning standpoint, the planning software we use knows that California does allow, you can have huge amounts of property tax, and that's still deductible in California. And if someone has a lot of investment expenses, it can cause their California tax amount to be a lot less relative to their gross income compared to the Fed side. The big benefit on we lost a lot of itemized deductions, but the eliminating the piece limit, which was, I just call that an itemized deduction cutback. It would really chop down what your total itemized deductions could be as your income went way up. So you picture somebody who they made $50 million. They had a bunch of RSUs vest at some huge tech company, and they think, okay, this is the year to just go big on charitable donations. And then they're very disappointed to find out how much their donation was cut back. So now that limitation is out. So California, again, didn't conform. So that's still something to be aware of when doing planning, is you can't just add someone's tax brackets together and say, yeah, you're going to have this savings if you make this donation, because I've had clients be very unhappy when they see that California really cut back what their benefit was as their income got very high. Okay, and then the AMT, that was restructured on top of the main driver. What usually drove people into AMT was their taxes, because taxes was something that was not deductible under AMT. So not only did that basically come to an end because of that 10 grand limit, but the actual structure of AMT changed. So I would say the number of clients that are in AMT is down by probably about 90% over 2017 between those two changes. And so I talked about this earlier, how did the 2018 change really impact projections? The state payments aren't relevant anymore. The AMT was a big planning issue. We don't have to worry about that too much anymore. The prepaying prop taxes is no longer a thing. Okay, so getting into CARES Act, the qualified improvement property was a big kind of correction that was made. So for non-residential property, this is something that you're seeing a lot in the real estate world, where assets that would have a 39-year life, their clients are getting this bonus depreciation of 100% on. So there's a lot of that in conjunction with the NOL carryback is driving a lot of 2020 business losses that can then be carried back, where they basically fixed something in the regs where they had neglected to make qualified improvement property something that you could take the bonus depreciation on. So that's just for business owners. The let's see, the question on RMDs. Okay, so the CARES Act waived RMDs for 2020. And we see it as, it really depends on the client and their specifics. I'm not going to say every client should not take their RMD, because it could be that they don't have a concern about higher tax brackets in the future, or they don't have large IRAs. And so, for a lot of them, it's just, and they need the money. Sometimes you have clients who they rely on it, and it's not something that's going to have a benefit over a multiple year period. But when clients have large amounts of wealth and they really have control, and I view that IRA, if you have RMDs you have to take, it's like this faucet that's just running whether you like it to or not. Now you have a chance to turn the faucet off for a year, and instead we're having a lot of clients look at a Roth conversion. So if you're looking at articles on 2020 planning, that's probably the most common tip suggestion that I'm seeing, is to take the money that would have been an RMD and doing a Roth IRA conversion. And so and typically you can't just take your RMD and say, I'm converting it to a Roth. You would typically have to, you take your RMD, you're taxed on that, and then you'd have to convert some other dollars from your regular IRA. But this year, you can take an amount. I've done some plans in the last few weeks where the client wanted to go right up to the point of the Obamacare net investment income tax kicking in, which for a couple, I think it's adjusted gross income of about $250 is what triggers them now paying an extra 3.8% on all of their investment income. The other kind of break point would be the 24% bracket. So I think it's in my next slide here. On the Roth IRA conversions, they've always been a great tax planning tool for the client who, for whatever reason, has a temporary reduction in their income. It could be they sold a company and they're not working for a year or two, but they're going to have earned income later. Or they've got business losses and they want to take advantage of the low rates, because that's more back to that idea of not squandering an opportunity to have a 0% rate. The Roth conversions are just an opportunity for someone with very high net worth to do tax rate diversification. So putting money into an account that they know is never going to be taxed, fingers crossed. I can't imagine any politician being willing to take that on, given that the money's been taxed. When you do a conversion from an IRA, you report that as taxable income, you subject it to income tax. So for clients who are worried that, some of the future changes that could be on the horizon that relate to the high net worth taxpayer who just doesn't pay very much income tax. So a lot of clients are concerned that they won't always be able to have their muni bond interest be fully tax-free. I don't know what changes could come about in the future on that side, but to me, having a chunk of money in the Roth provides a little tax rate diversification, and this is a great year to do it. So I've been seeing a lot of planning around that. The distributions, when you take them out, 100% tax-free, and then the fact that you don't have RMDs from them, if you did, it wouldn't hit your tax return anyway, but it just allows for more compounding. Part of the downside of the RMDs not only are you having to pay tax, and for some clients it's at the top rate, but now that money isn't able to grow tax deferred, tax sheltered anymore. And so that when financial advisors with very high net worth clients are running scenarios, a lot of times it's that compounding of the Roth very late in life, and then the benefits to the next generation are where they really see the payoff of putting the money in the Roth. So I'd say I would consider it more of a strategy for people who just don't need the money to live off. It has advantages for the next generation and the way that they inherit. And as I mentioned before, the break point that I see a lot is there's the 24% bracket starting in 2018 for a married couple was made very wide, up to 326,000 of taxable income. So in the past, if you had 300,000 of income and you're married, you would have been in the 33 bracket. So that was a big change with the 2018 tax reform. And so a lot of clients are saying, okay, that's kind of like I want to go to the top of a bracket, and the next one up, I think, is a 32 bracket. So that's usually the spot that they'll pick as where they want to go. And then we'll plan every year to make use of that 24 bracket and do Roth conversions. And it's something that we'll wait till later in the year. Another good tip though for the Roth conversions, the best time to have done it would have been when the stock market crashed, because you really want to be able to take the depressed asset prices, put it into the Roth with the theory that you're going to have some rebound effect, and that's happening while the money is in the Roth instead of in the IRA. And you do it when the market is strong, you're having to pay tax on more, and you're just getting less growth happening inside the Roth. So what I've told clients is we're going to do a certain amount now, and then next year we're going to plan to do a big chunk sometime in November or early December. However, if there's a big market correction, then we'll take advantage of that and do the Roth conversion at that time.
Can I
Question.
ask you a question, Nick? Yeah, we
Yeah.
got a question that I've been saving from the group. I know you don't have a crystal ball, but because so much is up in the air, even now as we speak, with respect to the CARES Act and not having to take the RMD in 2020, do you think that there's a chance that we may not have to take the RMD again in 2021, or may have the option to not take it, just perhaps as part of some sort of a relief bill, going into 2021? What are your thoughts on that?
I don't think there's much chance of that, because the motivation at the time was they didn't want to make people take, at the time that the CARES Act was drafted, the stock market was just in the tank. I mean, it was down, I don't know, 25, 35%. So the real motivation was to not make people take distributions from their retirement account when the assets were depressed, and they didn't want to further drive down asset values. So in a way, it was partially to try to prop up the stock market. I mean, I don't know how much impact the RMDs really have on that, but the number one motivation was to not force seniors to sell stocks when they were down. So with the economy having, or at least the stock market having recovered, and that short-term concern that we were in the middle of a giant crash, I don't see them offering that up again. I haven't heard any discussion like that.
Oh, great. Thank you.
Okay, so another CARES Act related change that has affected some people with planning. It was more of a cash flow planning for people who, most of our clients are doing pretty well to where they're not struggling with cash. However, you do have a lot of businesses that completely went under. We have restaurant clients, we have clients in the food business who service restaurants, and they obviously were struggling and looking for access to cash. And so one of the rules that was enacted that allowed for something that's not normally allowed is that you could take up to 100 grand from your IRA or 401k. And when they first announced it, it looked like a pretty sweet deal because it was going to be, you can take out 100,000, no penalty if you're under 59 and a half. You had 3 years to pay it back. And if you did, there'd be no tax on it at all, as long as you put it back by the end of 2022, because this was something that announced in, I think, May of 2020. And so initially it seemed like a very flexible opportunity to get some cash in people's hands and not really have to worry about the tax impact. And if they paid it back by the end of 2022, no harm, no foul, no need to amend any tax returns. Then later there was a clarification by the Congressional Joint Committee on Taxation saying, if you do this, if you take the 100 grand out, you can either pay tax on it this year with no penalty, which is better than it would have been in any other year in the past. Typically, and California conformed to this also. So really you're saving, because California is a 2.5% penalty. So you're saving 12.5% if you're underage and you take this money out. But what they said is you're going to have to each year report 1/3 of the income until you return the money. Then if you return the money, you go back and you amend the tax returns and you get a refund at that point, which is much less appealing to people than to just be able to only have to amend if they don't put the money back in. So a lot of clients were thinking about that. Once that clarification was provided, most of them opted not to do it. And also by then, the PPP had come out and there was a little bit more relief. At the time this was announced, there was a lot of doubt as to where people were going to get money and what was going to happen. And they thought, I want to get out of stocks anyway, because the market is really going in a bad direction. So that proved to not be very popular. Something that is kind of minor but worth mentioning is that the CARES Act did create this deduction for charitable donations directly to be taken against gross income. You can only do $300, so it's really not something impacting the high net worth clients, but it's never been available before, and it's something that you're always going to see in any kind of tax planning summary. Is a lot of clients, and it's something I'm going to get into, even very wealthy clients, they're not itemizing anymore. A lot of them have paid off their mortgage, so all they really have, they don't have mortgage interest, and that's really the difference maker now that you don't have the ability to just deduct all your taxes. And so not only was the standard deduction increased, if everyone's itemized deductions dropped way off, you have a lot of clients who are seeing that their charitable donations aren't getting them any benefit. So one way to navigate this is the QCD, the Qualified Charitable Distribution. I'll say I prefer for clients to first look at their portfolio and look for highly appreciated securities on a percentage basis. And I like to see them donating those to a donor advised fund and really bunching that. If they're the type of client who would take the standard deduction and they have high income, and so they can really defer a lot or avoid a lot of tax, I would rather them donate the highly appreciated securities rather than donating cash, or even when you do this strategy, the qualified charitable distribution, which is taking money right from your IRA and going right to charity without it ever hitting your gross income. But you're still donating cash, and it means that if you're ever going to sell these appreciated securities you have, you're going to pay capital gains tax on it. Now, if they have huge cap loss carry forwards, that's a little bit different. You have to kind of look at them holistically. But my first look is to see if there's going to be gains triggered, and we're going to see tax on that later. We can get more in the hands of the charity by donating appreciated assets, and by using the donor advised fund for clients that like to give to certain charities a set amount every year. They don't want to make some big gift by doing the bunching, which is a tactic that you use now, so that in the year that you do itemize, you're running up through the standard deduction and making sure that you do all your donations in 1 year. So a lot of clients will say, let's only do donations every 3 years. We'll do it to the donor advised fund, and then you can still donate from that fund to the charity every year. And that way, this isn't tax related, but a lot of clients they make a big donation to a charity that's unusual, and then the charity expects them to do that every year. And so instead of having these good feelings from the organization, they're getting these letters as though they're kind of letting the people down by, why aren't you donating this year? And so by using the donor advised fund, they can really smooth that out. So I'm sure a lot of people on the call are very familiar with this, but in case you're not, the combining appreciated securities, which they're subject to a lower limitation as far as how much you can deduct in any year. So you have to navigate around those rules. Also, it's 30% of your adjusted gross income can be of appreciated assets. And so if you're doing cash, you can do 60%. But for some clients, they just don't have much left. They've already exhausted that strategy, or they have unrealized gains. But if they're much older, they're thinking, okay, I'm going to get the step up. I'll just hold these until I pass away. I don't have to worry about the gains on them anyway. So we believe that the step up is safe, have it at least for another 2 years. So the qualified charitable distribution really helps for that client once you've exhausted the other avenues, where they're able to bypass the whole limitation on their AGI. It can also help keep their AGI lower, which can help with other deductions, maybe even the QBI deduction if they have passive investments in businesses that generate that new QBI deduction, which can be limited if your AGI goes up. So it's definitely a good option. Now,
Nick,
someone,
sorry. I just wanted to make sure that we were following along on our timeline. We have just a minute or two left, although we hate to see you go. So I didn't know if there was anything that you wanted to kind of touch on before we wrapped up. I am going to post your LinkedIn in the chat, and feel free to list any other contact information as well, because I'm sure folks will probably want to reach out to you with some of the questions that they have saved or will think of after the fact.
Okay, yeah, and at the end of my slides, which I think are going to be emailed out to people, my contact info is in there also, and I'm on LinkedIn, so feel free, everybody, to connect with me on LinkedIn. I'm just going to run through a couple of these last ones. So someone talked about purposely triggering capital gains, and for taxpayer who has very low taxable income, which we have some clients that they sold a company, they're used to having huge income, but they're invested heavily in munis. And so we plan to make use of the 0% bracket. And so, yes, we do sometimes trigger capital gains. It's only up till about 80 grand that we do that. But, if someone has business losses, then that could be a strategy that they use. If you have clients who are tech executives and they have incentive stock options, with the AMT changes, I'm doing quite a bit of work in this area where there's this amount that they can exercise of incentive stock options and not trigger AMT. And so for people who they only have the cash to exercise, and there's so many companies staying private for so long, there's definitely a need out there among younger people to know, okay, how much can I exercise and not have to pay AMT, which is essentially a prepayment of tax on a gain they may never see if the company never goes public. So there's this kind of runway that's been built in now under the code. The RSUs, I'm very mindful of clients who have big RSUs that there's chronic under withholding on the federal side, up to $1 million on their payroll. They only have it withheld at 22%, but they get into the 37% bracket at about, I think about 450,000 of income joint. So when it comes to really any of these big tech companies that have big RSU packages, I'm always mindful of making sure that clients know toward the end of the year, okay, we're behind, like when can we pay it? How long can we defer it? So being mindful of that. And also California, they don't allow you to, if you go over $1 million, they don't allow you to use safe harbor for your estimates. So we're a lot of times looking at really projecting exactly what their California tax is going to be. For the really high earners, their RSUs only are going to get withheld at 10.3%, and the top bracket is now 13.3. So we have a group of clients that routinely has 50 million in income, and their California withholding is low by about $1.5 million. So the California statutory RSU rate is something that we look out for. And then there's the gifting. I'm going to leave that out because it's more of an estate planner topic, and we're kind of out of time. But just be aware that the simple trust in the past that often you just didn't expect it to have any tax as long as there were no capital gains. A lot of those simple trusts now actually do end up having tax with the way that the 2% miscellaneous itemized deductions get treated, and how it can create a scenario where a simple trust has tax. So a lot of times they get extended in April, assuming no tax, and then you find out in August, September, that there's going to be tax and late payment penalty. And then I've got a little chart here for the trust and estate income tax deductibility of certain expenses, just because I get a lot of questions on that. And it's pertinent to the people in the group. So you can check out that chart. There was a clarification that we got recently that in the final year of a trust or estate, the trust or estate will pass out these final year deductions, which are kind of a relic of the 1950s tax code. Not really sure why they still allow this, but if you can close a trust in the same year that you have most of the expenses, normally they would just be lost if you had negative taxable income, but if you can pass them out to beneficiaries, and we got clarification that those are actually allowed as other miscellaneous deductions. They're not considered 2% deductions, so they were not lost based on the changes to the tax code. And this is on the Biden plan, which I've already covered all this. One other thing to note, this is property tax related, but a prop passed yesterday, Prop 19, and there's a deadline associated with it, February 15th of 2021. I posted a good article that I read, which was written on the assumption that this might pass, on what can clients do between now and February. because on the plus side, or on the downside, the parent to child exclusion has essentially been stripped away at death. So there's going to probably be a lot of gifting that takes place to try to still maintain this low property tax basis. But also clients over 55 now can move to any county in California, and they can actually move to a more expensive house, whereas previously they were limited to, I think, 4 or 5 counties, and they had to go to a place that was equal or lesser value than where they were living. So Prop 19 is something definitely to look at in terms of doing your estate and gift advice, because starting February 15th, that will go into effect. I think it won by a pretty big margin, and so I don't think that was in doubt at all as of this morning. So there's my contact info. Yeah, anybody can reach out to me with any questions on this, and I will unshare my screen now.
Thank you so much, Nick. Nicole, is there any other quick questions that we can answer, or are we good?
No, I just wanted to sort of point to the chat for the next few minutes while I'm droning on and on. You can find the LinkedIn link to connect to Nick there. Our executive director has shared the link to his presentation, so make sure to click on that and download that. Nick, yeah, just echoing what Jody said, thanks so much. There's been a lot of crazy stuff going on, and it was nice to have you come in and talk about it and what we can kind of expect in the future potentially as well. So much appreciated.
You're welcome. Happy to do it.
Yeah, thank you, Nick. You're very in-depth. That's really good. That's what we're all looking for, really in-depth conversations. So PEPC members, again, sponsorship is open for December only for the rest of the year. We also too, as board members, we want you to know we're approachable. Please come and talk to us. We want to hear your ideas. We want you to join the committees that we have. We have some great committees, and we need your help. So come on aboard. We'd love to hear from you. So everybody have a wonderful, wonderful day, evening, and we'll see you December 2nd again for our next meeting. Looking forward to it. And it's going to be our December meeting, so it'll be a lot of fun. Thanks, everybody. Thank you, Nick. Nicole, thank you. Bye.